debt versus equity. So for the most part, debt holders or bond holders, they're going to have first claim on the firm's cash flow. The stockholders claim or stockholders equity is that's the residual difference between assets and liabilities. If we they remember that stockholders have limited liability, so if happens that a firm is liquidated and the liabilities are greater than the assets, the stockholders would not face any additional liability other than the loss of their investment. So this is an important aspect of investing in stocks. This is one of the big reasons that people invest in stocks. If this were not the case, a lot fewer people would invest in stocks, and the prices of those stocks would be much lower. Value versus cost. Under generally accepted accounting principles, or GAAP, as most people refer to it, audited financial statements in the U.S. carry assets at cost. It's actually depreciated cost. The market value is the price at which all of those assets, liabilities, and equity could be bought or sold, which is a totally different concept from historical cost. So next we move to the income statement. The income statement measures a firm's financial performance over a specific period of time. In most cases, this is 1 year. We sometimes firms do interim financials. They 10Qs and 10Ks would likely contain quarterly information. Accounting definition of income is revenues minus expenses equals income. So this is a typical income statement for a U.S. corporation. The first section is the operating section. We have operating revenues, or in a lot of cases this would be listed as sales. Then we take out cost of goods sold, selling and general administrative expenses, depreciation, and we come up with operating income here. And next we're going to we move down to the non-operating sections. So we should add in other income, and this could be income from investments or interest earnings of some sort. That we add that in, and we come up with earnings before interest and taxes, or EBIT. Next we subtract out taxes, and we get pre-tax in. Sorry, we subtract out interest, and we get pre-tax income, or EBT. A lot of times you'll see, or earnings before taxes, it'll be referred to. We subtract out taxes. Those taxes are, and for the most part, most corporations pay a 21% tax rate in the U.S. That was lowered from around 44% with the Tax Act of 2017. So this will see that taxes here are broken down between current and deferred. So the current portion being the portion that would be due during this time period. So after we take out taxes, we have net income. And then when we calculate our income, this is when the firm makes that decision. Are we going to reinvest it? Which, in that case, that's addition to retained earnings, or pay it out in dividends. It's a really important decision. So the corporations typically separate out the section that reports taxes. And then finally, net income is what we refer to as the bottom line. So, income statement analysis. The three things to keep in mind when analyzing income. First is generally accepted accounting principles, non-cash items, and time and costs. So, GAAP. So, the matching principle GAAP dictates that revenues be matched with expenses. So, income is recorded when it is earned. As I mentioned this previously, even though the cash flow may not have occurred. So the cash flow may not occur for some time, but it's recognized when the transaction occurs. Non-cash items. Depreciating. Depreciation is most apparent. Firms don't write a check for depreciation, but they recognize it in their income statement. Uh, so another non-cash item is deferred taxes. So it doesn't represent a cash flow at this point in time. So thus, net income is not cash. So time and costs. So in the short run, equipment, resources, commitments of the firm are fixed, but the firm can vary inputs like labor and raw materials at any point. In the long run, all inputs of production and costs are variable. The financial accountants don't distinguish between variable and fixed costs. Instead, accounting usually fit it into classification that distinguishes product costs from period costs. Yeah. The next, taxes. So the one thing they can always rely on is that taxes are changing. We've seen that the Tax Acts of 2017, the Stimulus Act has temporarily waived the $10,000 maximum for state and local taxes. There's various, and this goes on all the time. The Tax Cuts and Job Acts is what I was referring to, of 2017. You can go to the IRS website for complete up-to-date information. I probably bore you to death. So average versus marginal tax rates. This is very important. So average is important, but when we do analysis and decision making, it's going to be based on marginal tax rates. So what is average? Average is simply the tax bill divided by your taxable income. Marginal is the percentage paid on you can state it as the next dollar earned or the last dollar earned. But we also have other taxes that a corporation may pay as well. Those could be property taxes. There are also state and local taxes that corporations may pay as well. All right, so we'll start the next lecture with greater discussion of average versus marginal tax rates.